Welcome to Think Learn Finance. By the end of this video you will take away the following. What an index fund is. How an index fund works. The benefits and drawbacks of index funds. And finally, the different types of index funds. Let's start by taking a look at the basics. So, what the hell is an index fund? In simple terms, an index fund is a type of investment fund that aims to track the performance of a financial market index, such as the S&P 500 or the FTSE 100. These are the top 500 companies in the US, and the top 100 companies in the UK. For example, in the case of the S&P 500, you can think of it as being able to indirectly buy all 500 companies, with a single purchase. While you don't directly own the underlying 500 companies, you are able to benefit from their growth when they do well, as the investment you hold invests into them for you. Now, how the hell does it work? An index fund buys all, or a representative sample of the companies within the index it is tracking. The fund's composition is designed to be closely matched with the composition of the index. The fund's performance is determined by the performance of the underlying companies in the index. If the index goes up, the fund is likely to go up as well, and if the index goes down, the fund is likely to go down as well. As the index changes, the fund buys and sells its holdings to maintain its representation of the index. Let's take a deeper look now at what the hell are the benefits of an index fund. Index funds have lower fees than actively managed funds, due to the fact that they replicate an index, rather than having to pick the best companies or time the market. These lower fees can have a significant impact on long-term returns. Index funds provide exposure to a broad range of companies, reducing the risk of investing in a single company, group of companies or market sector, therefore providing a low-cost opportunity for diversification to investors. Index funds have historically provided consistent, long-term performance that has been comparable to or better than actively managed funds. Index funds are easy to understand and do not require active management, making them suitable for both novice and experienced investors. We have touched upon the benefits, so let's now look at the drawbacks and what the hell are the disadvantages of an index fund. Index funds are designed to track the performance of the underlying index, not to outperform it. Portfolio returns will be roughly in line with the index. Index funds are subject to market risk, meaning that the value of the fund can decline if the underlying securities in the index decline in value. The underlying market index may have a bias towards larger market cap companies, which can lead to a bias in the index fund's portfolio. This can limit exposure to emerging or small companies. Index funds are passively managed, which means that they do not have a fund manager making active decisions on which companies to buy or sell. This means that during periods of market volatility, the fund will simply track the market, unlike an active fund which would try to take defensive action. Finally, what the hell are the different types of index funds? Not all of these will be important to you, but they will give you ideas about what you can invest into, using index funds, which can be a great starting point for new investors. Stock index funds, these track stock market indexes such as the S&P 500 and the FTSE 100. These are the top 500 companies in the US, and the top 100 companies in the UK. Bond index funds, these track bond market indexes such as the Bloomberg Aggregate Bond Index. International index funds, these track foreign stock and bond markets such as the Nikkei 225. The Nikkei 225 is the top 225 companies listed on the Tokyo Stock Exchange. Sector index funds, these track specific sectors of the market such as technology or finance. Style index funds, these track the performance of actively managed funds with a specific investment style, for example, value investing. Real estate index funds, these track real estate indices such as the MSCI US REIT. These indexes can give exposure to the real estate market including both residential and commercial properties, without having to purchase the properties yourself. Commodity index funds, these track commodity market indices such as the S&P GSCI. These indexes can give exposure to the gold, coffee, cattle, oil, metals, and other commodity markets, without having to directly partake in the purchase of complex investing instruments. A good starting point is to research an index fund in an area that you are already familiar with. For example, if you work in healthcare, perhaps begin there, or if you are a software engineer, then it might be worth studying sector index funds based around tech. If you learned something from this episode, please hit that like button and subscribe. Don't forget to check the bell icon to be notified of our new videos. And remember, not everything that shines is gold. Catch you in the next episode.